of how can we connect people across the ecosystem to try to empower women in their careers. And he goes all the way from the beginning of the life cycle in college or even in high school to start mentioning to females and people in general, did you know there's this ETF ecosystem out there? Because you can be sales and distribution, that's me. You can be research and strategy, that's Brad and a few others. You can be a portfolio manager, you can be a trader, you can be FINRA, you can be part of the index providers. The ecosystem is incredible. And I do think that women in ETFs over this past decade has started to accomplish a lot of that goal of educating, connecting, and empowering people across that ecosystem. So while women in ETFs actually was conceived, originally thought of here in Miami, this is one of the newer chapters. So thank you for joining us. Deborah Drager was one of the original founders. We also have 3 important members of the Women in ETF South chapter here today, Estefania Gorman, Jan Fredericks, and Anka. So thank you for all your efforts. And if you are based here in Miami, I encourage you to reach out to these ladies or myself about how you can get more involved. But for those who don't know me, I'm April Repi-Sadam, and I'm wearing a couple hats tonight. Right now, kicking off today's event, I'm part of the Women in ETF's global leadership team. I'm based in Chicago, and I got started with Women in ETFs when I moved there from Philadelphia because I was with Vanguard at the time. I had no network in Chicago, and purely by chance, when I was looking for industry groups, Women in ETFs had just started. I went to a mentorship dinner, and then naturally, I raised my hand and said, hey, I have some ideas. So I started launching mentorship programs for women in ETFs. Currently, I'm sitting on the global sponsorship role, and we'll be rolling off that shortly. So thank you on behalf of Women in ETFs for being here tonight. Later, you're gonna hear me on a panel, and that one I'm gonna put on my hat as head of distribution for Latin America for First Trust. But without that, Christian Pruge, a dear friend and colleague in the industry, I want you to come up and make sure everybody knows who StoneX is. And then we'll get started with the
Great to be here because, being at home and seeing so many faces that good old friends I've seen in a while, colleagues, and of course, always great to meet new people from the industry. So as April was saying, StoneX is a global financial services company. We are based in New York, but we have offices, about 80 offices all over the world. Our office here from Miami, we focus mainly on Latin American institutional clients, and I'll say like 95% of our flow are ETFs. Having said that, I've been trading ETFs for 25 years now. So I just can't believe when someone says like, what is that, or how does that work? Or people are kind of confused with exactly the concept, because I think that the best part of ETFs or the best way to sell an ETF is just like, look at the track record as of how the industry has grown. And that's, the best reason why people more and more are moving into ETFs. Of course, the industry is dynamic. We have seen the active ETFs, we have seen the different sectors and stuff, but it's always the dynamics of the industry what it makes it interesting. So it's not like passive, boring stuff. There's always new things we can do. And for us, StoneX, we're very happy to sponsor this, and I'm pretty sure we're going to have a very interesting night with the whole panel that we have for tonight. Okay.
Thank you.
Thank you.
Thank you so much. So hopefully you all signed up because you saw the agenda. So just by way of introduction, we're going to kick off with 2 incredible speakers who are literally going to have a fireside chat. Imagine a virtual fireplace. It's too warm in Miami to actually work. But we're going to welcome Kathryn Rooney Vera and Jonathan Levin to the stage. We're going to start.
Thank you.
This first segment is Economics Unplugged. And buckle your seats. I want to take a seat and take notes, but they're going to dig into some wonderfully fascinating topics, very relevant today. Then we'll take a quick pause. Make sure if you want more drinks, There's more out there. But we're gonna then take a quick pause. We'll shift to the second panel where we'll put them into some trends, and then there is a very awesome chocolate and wine pairing at the end. So I hope you can stay all the way through. But with that, thank you and welcome.
Thank you, April. That sounds absolutely lovely, chocolate and wine pairing. Well, thank you everyone for being here. I'm Kathryn Rooney Vera, Chief Market Strategist at StoneX. It's a pleasure to be here with you. And let's make this interactive. John and I are going to have a fireside, and then afterward we'll be taking questions from the audience. So Jonathan Levin is a dear friend of mine for many years. We're in emerging markets together, and now we're covering kind of global macro, equities. And anyway, John, do you want to introduce yourself?
Absolutely. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion. Kathryn and I get the opportunity to work together a lot in a different capacity. We do these live streams all the time when big macro data is coming out, when the Fed is coming out with a decision. So this is a great opportunity to do that exact thing, but
Yes.
for a live audience and before a great organization that we just learned all about from April.
And
so
in person.
Let's dive in.
But John, those live streams are awesome. They're on X, and John does them just before and after every CPI print or non-farm payrolls print or any important data. And the viewership is extreme. We're talking 80,000, 90,000 viewers. It's pretty impressive. So congrats on that. John, let's start out. Maybe I'll start out with a kind of a broad strokes of how I'm viewing things, and you can interject or I'll ask you some questions, and then you can also give me your broad strokes views.
Take it away.
But today we got, just as I was driving over here, NVIDIA earnings. Probably everyone heard of that, and the real zeitgeist now in the markets is AI in a bubble. So that's what everyone's talking about now. I just got off the plane, John, 3 days ago from Singapore. I was in Singapore, Korea, and then 2 weeks before in Argentina and in Malvern, Pennsylvania, seeing your former employer. That was the past month. And in the past month, asset allocators, asset managers, investors, hedge funds across the globe have been talking about this. What's going on in AI? Who's going to win the AI war, US or China? And where to for the S&P? I'll give you my first blush answer. The S&P is trading at 23 to 24 times earnings, and not to jump the gun, but John, you can jump in here if you would like to. Doesn't mean because we're at stretched valuations that the market is due for a correction. Because PE ratios, multiples are not forecasters, they're amplifiers. So if you get yields that stay low rather than move higher, if you get earnings that continue to beat like we've seen, which has been remarkable, I would argue very impressive, then you can continue to see a melt up. So you can see multiple expansion, you can see prices go higher. And I think that's the phase that we're in from now through year end. There are some headwinds on the horizon, but I would argue that where we stand at the current juncture is in a very good place, especially with earnings coming out, validating these high multiples. John, do you have a take on that?
Yeah, well, so from the outset, I think we all have to come at the question of, are we in an AI bubble, with extraordinary humility, right? One of the exercises that I get to do almost every year as a Bloomberg columnist is look at what the strategists are saying about what's going to happen the following year. And almost invariably, the consensus expectation is wrong. Sometimes spectacularly wrong, and sometimes a little bit wrong. And so, one of the things that I've learned in my profession is be extremely humble. Having said that, I think that there are a few things that we know empirically, such as through the work of Robert Shiller and John Campbell, who have looked at valuations going back to the late 19th century. And what do we know? We know that the cyclically adjusted price earnings multiple, when it is high and when you regress it against forward 10-year real returns, it's a pretty darn good indicator of what's going to happen over that sort of medium, longish term horizon. So I think you come at it with humility. I think you come at it with the understanding that if you try and time what you think is a bubble, you'll probably get your face ripped off. But
so don't go short NVIDIA quite yet. Is what you're saying.
I mean,
and I would agree, by the way.
It's not my job to give investment advice. That's you, but probably not. Probably not.
Right.
Not tomorrow, anyway.
Well, the interesting thing, John, is that CapEx is what's driving a large portion of economic growth. In the U.S. economy, you have consumption, you have private investment, you have government investment, you have exports minus imports. And CapEx spending, especially on AI, is so robust. And that's really what's driving, I would argue, valuations and as well as a lot of the economic growth. In addition to that, you have fiscal spending, which really isn't allowing a change in the economic cycle because it's such a strong impulse. So you have a fiscal deficit here in the United States at 6.5% of GDP, which, by the way, historically, you don't usually have. Why? Because we're not in recession and we don't have like a global pandemic or a financial system collapse going on at the moment. So you have these two tenacious variables, which are fiscal profligacy and massive investments in CapEx. At what point do we worry about that CapEx not turning a profit? And I'll just add one more question, and this is something that I'm thinking about is, and I'd like your thoughts on this as well, is that you have about 40% of all revenues from these big guys, the big guys in the S&P, plowing that into CapEx. And the market's applauding, and this is awesome, this is wonderful. So it's kind of like this arms race for AI expenditure and CapEx. And then the question is, at what point does the market say, okay, enough is enough in terms of spending. We want to see productivity and returns at this point. Does that come first, John? Or do you think what comes first is potentially this energy wall that we hit? We smash up against this grid, these bottlenecks that we have in Virginia and Texas and all of these things. Which one comes first?
Well, see, you're asking me to pull out my crystal ball here, Kathryn.
Well,
I don't have one. I wouldn't be in the journalism business if I
true.
could see the future.
But those are the two headwinds. Would you agree?
100%. I guess one thing that I would say, people often come at me with this idea that like, market's not going to wait forever for those investments to turn into profits. But, I mean, if there's not a forcing event, such as a recession that causes people to lose their jobs and liquidate their portfolios, if there's not a forcing event, I think one thing that I've learned about this market over the past several years is that if they believe in a story really strongly, they are willing to follow it to the end of the earth. I mean, let's just take as an example Tesla. Right? For however many years, the narrative has changed every several quarters on Tesla. Right? First, it was an electric car company, and now it is all about robotaxi. So we keep sort of moving the goalposts here. But the market believes in Elon Musk as an entrepreneur so deeply. They believe in him as a storyteller that they're willing to go along with him. I mean, Tesla today is, I think, 175 times forward PE stock, but people are still willing to go along with it. And so I've learned that this particular market, we talk about regime change and so forth. This particular market is willing to be credulous.
Yep.
I don't know how long that goes on. I don't know what that looks like when a shock comes our way, whether it's geopolitics or something that might happen in the labor market. But I do believe that it's also really perilous to bet against it.
It is, John, and one of your articles, so Jonathan Levin does, he's, as you mentioned, a Bloomberg columnist. He writes a lot of interesting articles, but one of them I thought was particularly interesting because you talked about, and I'll maybe even answer my own question here, but you talked about how, this broadening of the appreciation of the S&P and this broadening of the market is not quite as robust as people have been talking about. The equally weighted S&P hasn't really done as well as everything else. Nvidia is 7% of the S&P. The Mag 7 are a third of the S&P or something like that. So I'd like you to talk about that, but I would like to go back just what I think could put the brakes on this one-way ride to the atmosphere in terms of tech is if you get any disruptions or missed earnings expectations from anyone, NVIDIA didn't disappoint today. But if we are to see any disappointments in earnings guidance or expectations or cracks in the seams with regard to what you talk about momentum and this vibe, this feeling for tech, then I think the extended multiples and that demand for profits or at minimum productivity come back to bite the guys who are just plowing money into this and saying, I pray it's going to work one day. In my opinion, I think going into the next phase of this economic cycle, and this is what I'm going to write for 2026, is that productivity, in my view, is going to be the key factor next year. It's not going to be the fiscal, it's not going to be the Fed, it's going to be productivity. Who delivers? So yeah, so if you plow, I don't know, billions of dollars into CapEx for compute, but you don't have productivity or you're not a user, I think the market's going to start to be more discerning and they're going to be watching earnings. But talk to us a little bit about what you're seeing on that broadening of the S&P and the breadth, which really hasn't really caught as much oxygen as one would hope.
Yeah, so for a number of years, I think we talked about how all the earnings growth in the S&P 500 was coming from the Magnificent Seven. And there was a lot of empirical evidence behind that. It was kind of just a fact. One potential positive that we've seen in 2025 is that we have seen a broadening beyond just those top 7 stocks. It's not narrowly concentrated around just a few industries, semiconductors or something like that. So that's mildly positive. But I'm not super optimistic about it because I still think that we're observing a different version of concentration. I think you now see industrials performing, which is good, but a lot of the reason that industrials are performing is because they're getting into the data center action and things like that. You now see utilities performing, also part of the data center story. So when you step back, you might be able to fool yourself into saying, well, this is a much broader market. Now I have earnings breadth in 5 sectors instead of 2. But in reality, a lot of these things are revolving around the same story. So there are narrowly concentrated markets that do very well for people for a very long time, but we shouldn't fool ourselves into thinking that we are perfectly diversified when in fact it's a similar narrative that is driving a lot of these
Which
things.
makes us more vulnerable.
Yeah, for sure.
Because it's the AI narrative. Yeah, we've brought in out financials is another one. Industrials, materials, that's basically precious metals, right? Discretionary, Tesla and Amazon is in earnings recession. Staples are negative.
Right.
Small caps are doing poorly. So the sectors that are doing well, apart from tech, are related to tech.
Yeah. And one related interesting phenomena that I think comes from this, it's a really interesting mental exercise for those of us who have thought a little bit about CAPM. Like for a while, this is starting to correct a little bit, I think, but for a while, the market was willing to pay really extraordinary multiples for a stock like Costco or Walmart. And I think that's because everybody is just so eager for something that's doing kind of well, but is not the AI story, because you have to diversify some way. That's my sort of half-baked theory on that one.
It is kind of
What do you
concerning. Think? Yeah, I think it's an interesting point, and I think people like comfort, and those names are sort of comfortable.
Yeah.
But what concerns me somewhat are names like Oracle that are free cash flow negative for the first time in 30 years because they're plowing so much money into CapEx. So I think there's going to be winners and losers, and I'm concerned about that. So I think that one of the things that what we're at least talking about with clients is take a look outside of the U.S. There's value there.
Like where, Kathryn?
So when I came back from Asia, one of the biggest, I'll tell you some interesting color from biggest asset managers in Korea and Singapore. They're plowing money into Chinese equities.
Okay.
I thought that was interesting. They see China structurally improving with the government making the right steps. And they don't think that the US-China friction is going to get any better, but they think it's seen the worst. So I would say Chinese equities is probably the #1 trade that I heard in Asia and Korea. So a lot of bullishness on China, and then a lot of interest in emerging markets. And I think that makes sense, because emerging markets have done very well for the past year, but they have a lot more room to run, in my opinion. And historically, you can diversify away from the US. The US is looking somewhat stretched. I'm not saying sell, but I am saying diversify. And I think that's probably going to be one of the best bets going into next year. But I think one of the main things that we're going to be looking at is, of course, the Fed, what the Fed does, and the evolution of the economic story here in the United States. So that leads me to the next question. How many think the Fed cuts in December? Does anyone think the Fed cuts? All right, who thinks the Fed does not cut? Okay, so that's about, I would say 50-50, maybe
This is
slightly.
just like the Bloomberg WIRP function, right?
You're absolutely right.
Pretty much. I think WIRP is at 30%.
And it collapsed today
Yeah.
because of the announcement. Go ahead.
About that we're not going to get an October jobs report, right? So people think the data fog means that an uncertain Fed is going to move more slowly.
So the question then becomes, if the Fed doesn't cut, how much room to rally do we have? And how bad of a place are we in the economic cycle? So I'm just going to preface this with, I think I'm a bit more positive than my colleague here, but I think that makes for a good juxtaposition.
Me, a negative Nelly? You calling me a wet blanket here?
Oh gosh, no, but I would like you to contrast my perspective, because I think it makes it more interesting. So what we're seeing in the US economy is still a resiliency, which you can see evidenced in the economic data. And when you look at every quarterly annualized data, we're seeing in the past 2 quarters, correct me if I'm wrong, above 3%. The Atlanta Fed GDP nowcast sees the next quarter at above 4%, which was just announced today.
In fairness, we haven't gotten much data recently, so
this is true.
We're modeling off of air.
This is true. So there is an elevated degree of uncertainty. And you can point, and I would like you to point to this, anecdotal data that you follow, which I think is very interesting, which just does show a softening. But I'm going to say something a little bit different from the consensus. I think it's good. I think it's great. Because we're all looking for this fabled soft landing. Soft landing was, what everyone was talking about a year or 2 ago. Mm-hmm. Soft landing, hard landing, no landing. A soft landing, no landing, hard landing, stagflation, recession. Where to for next year? It's what everyone asks me. Okay, so right now, let's say we grow at about 2%. Potential is 1.8 in the United States of America. 1.8, 2%. So we're growing at or slightly above potential, depending on how the data come out in the 3rd quarter, 4th quarter. I think they're going to come out pretty good. Going into next year, if we get a deceleration from above 3 to below 2, if we get an uptick in unemployment and we get a slowing of wage pressures, that could put some downward pressure on inflation in an environment where we're talking about additional stimulus. Fiscal stimulus, potential checks from the tariffs going to people's bank accounts.
Do you recommend those?
No, I do
Kathryn?
not. Japan doing stimulus, the Fed, leveling off quantitative tightening. The impact of potential impact of tariffs going into next year. There's a lot of inflationary impulses that could come. So I think a slowdown in consumption, I think a slowdown in the labor market, a slowdown in the US economy is not a bad thing. What say you?
Yeah, I'm probably not far from you, but I probably wouldn't argue that you need that to bring inflation down. The inflation that we're seeing today, CPI is running around 3%. Probably the run rate would be 2.5% if you take the tariff effect out of it. Why do you take the tariff effect out of it? Because economics orthodoxy would say that it's a supply shock, and so it doesn't really matter for monetary policy. So, we're running around 2.5%. If you further adjust for the imputations in the housing sector, maybe inflation is 2.3%. So you could conceivably get back where you're going without punishing the labor market. I do think, you talked about GDP here. I think that the way I think about it, I just kind of take GDP out of the equation at this point. The Fed has a dual mandate. It's the labor market and it's inflation. And the labor market is looking kind of wobbly here. It's hard to disaggregate what's going on with the supply side of the labor market from the demand side of the labor market. But what's clear is that nobody's hiring, and we have seen some alarming anecdotes about layoffs in recent weeks, including, I think this past week, Verizon with 20,000 people.
20,000, okay.
Yeah. I mean, I always say, be careful with the anecdotes. High quality data is obviously much better, but when you hear names the likes of Amazon or Target or Verizon, these are the sort of names that people pay attention to, and they give cover to other businesses, small businesses, to go ahead and cut headcount themselves. So it's a very confusing environment. All I can say is I really feel for the Federal Reserve right now, because there are forces pulling in both directions.
How much of it is their own creation? I'm going to be a little controversial. I think that we have this K-shaped economy, not in a minimal part because of both fiscal and monetary stimulus. And as the Fed cuts, if they continue to cut, I hope they don't cut aggressively, because that would be itself inflationary, I think, because of animal spirits and all this. Yeah. But it helps the haves. It doesn't help the have-nots, right? Guys who have 401ks and have their retirement stocked up in juicy equities that have done very well get richer. Right. But the guys and gals don't have stocks, are more impacted by inflation. You see the likes of what happened in New York occur. So populism gains traction. I think that's occurring. So I'm more concerned, I think I talk about this a lot, that the Gini coefficient, the haves and the have-nots is widening in the United States. And I think a part of it has to do with this asset price inflation that the Fed has been somewhat behind.
You think? I mean, I guess what I would say is your original question is how much of this is the Fed's own doing, and I think again the Fed has two jobs: unemployment in the aggregate, not at the micro level, and inflation in the aggregate, not at the micro level. And they have very blunt tools. They can't really get involved in questions of the distributional effects of their policies. Right. Otherwise, they could go the wrong route. So just take this year. How much of this year is their fault? I would say in my decomposition, basically none of it. So it's tough. I think the tariff situation has put them in a bind. When all is said and done, I probably agree with the orthodoxy that tariffs will fade out of the data and we'll all live through this, and there's no more sense in being panicked about it. But, Americans have lived with elevated inflation for 5 years. So you have to be cognizant of the potential for our inflation expectations to become de-anchored as we move into the 6th year. And that's the possibility that the tariff policy has opened up.
The interesting thing, however, is that tariffs have not been that inflationary, and tariffs did not derail the economy, and tariffs did not cause global recession, which is what everyone said was going to happen April 15th, Liberation Day. And in fact, inflation has occurred over the past 10 years because of enormous fiscal deficits, COVID, and a Fed that has kept rates abnormally long for too long a period of time, and bought bonds and bought mortgage-backed securities, bought all kinds of stuff they probably shouldn't have been doing. So I guess I wasn't talking about the Fed being culpable for this year, but for the past 10 years, inflating assets to the point that we see them now. And then I would throw in the argument that the government has a big role to play in this as well. Why? because we have an economic principle that no one talks about that I love. It's called crowding in versus crowding out. Crowding out of the private sector is what's occurring right now. And you can see it most flagrantly in the housing market. The housing market, owner equivalent rent has gone down, but housing prices nationally are still very, very high, and they're still rising nationally. The case S&P case shiller. So people can't afford houses. You know, their food is still expensive. Everything's still expensive. You know, Gen Z, millennials, not as much millennial. You're probably millennial. I'm not. I'm Gen X.
I'm an old millennial.
You are? I'm older than you. But Gen Alpha, these guys are pissed off because they can't afford stuff and they're locked out of the housing market. And I put that at the hands of unintended consequences, and it's crowding out of the private sector. So it's interesting because when you have a 6.5% fiscal deficit, that has to be financed. How does the U.S. government finance its deficits? By T-bills. T-bills are shorter than 1 year debt instruments that we issue to finance our deficits. Interest rates are high. So we are now, as a country, spending more money on a crappy spending, which is payment of interest, versus spending it on something else, which isn't crappy, investing in your country and in infrastructure, all of these things. So that's where we stand. And at the same time, you have a very slow-moving train, but I think it's a very real one, John. I'm getting a little philosophical on you, but we have an hour, so I'm going to go there. China's buying fewer treasuries. Saudi Arabia is buying fewer treasuries. Russia's buying fewer treasuries. All of these guys are buying fewer treasuries since the US government put sanctions on Russia back in 2022. Because China said, you know what, we realize something. If you're not in the friend zone, for the US friend zone, you're in trouble. So we're going to diversify. We're not going to allow ourselves to be vulnerable. So what has China consistently done? Brought their treasury positioning lower and lower. Now, there is no alternative to the treasury market. There's no market as deep or as liquid as the treasury market. So we're okay for now. But my point here, and I'm going to bring it all home, when you have crowding out of the private sector and you have to issue debt to finance everything, because outside of Medicare, Medicaid, Social Security, and interest payments, it has to be deficit financed. When the price inelastic buyers are buying fewer in favor of price elastic buyers, which are private guys, we care about price, sucks for you, to put it in economic terms. Because you have to finance at higher rates. And the guys who are buying your stuff now care about the price, because that's us. So 5 years ago, price-insensitive buyers, which is price inelastic buyers, central banks, were more than 50% of all holders of US Treasuries. Today, that's 30%. The remainder is the private market globally. So that matters. So my point here is that when you have crowding out, we're not going to have like some Liz Truss moment where treasuries blow out to 7%. But what we will have, and what I think is currently occurring, is potential growth shrinks. So an economy, the growth at which a country can maximize its potential goes lower. So we're at 1.8 to 2.2. Now we might be treading lower. Because I don't know about y'all, but I don't think that we're going to improve the fiscal deficit very much. I mean, I think it's fantastic that we got tariff revenues of $350 billion, which will take our deficit down to 5% next year. But that's a one-time thing. I don't think that's going to continue to occur. Unless and until we reform the main drains on the fiscal deficit, we're going nowhere. So I think that potential growth drops. I think debt remains very elevated. Deficits remain elevated. And that puts upside pressure on risk premium, you know? And that keeps us paying a very big portion of our revenues on our debt.
Yeah.
So now I sound like the bear, and
No,
you're going to sound like the bull.
Yeah. No. So we'll switch sides here. Yeah, this is fun. Okay. So on the question of America's exorbitant privilege, right? This is what the economists call the special privilege that the United States has because we are the reserve asset of the world. Everybody saves in U.S. Treasuries. Everybody transacts in the U.S. dollar. Some people think it's a curse more than a privilege.
I think it's a moral hazard.
Well, but I'll tell you, you could call it a curse. You could call it a hazard, but I don't know that it's going away so easily.
No, it's
that's
not gonna go away.
That's the question, right?
No, it's not gonna
you
go
said
away,
that
no.
we won't have a Liz Truss moment, but I wonder, if we'll even see a subtle erosion going forward, because the reality continues to be that there is no alternative,
Nope.
right?
For now.
Where are you going to go?
You're
are
not
you going to
gonna-
go to China?
I said that. I said there's no alternative. But what I added to it is that potential growth in the U.S. slows. So that means we
Because of the crowding out.
because of the crowding out. I mean, everyone's going to still buy our stuff, our debt, and you can see that in the bid to call ratio. Every time we have a treasury auction, it's very well bid. So
Right.
it's not happening now, but it is happening. And those are the empirical evidence is showing that price insensitive buyers are buying fewer proportional to price sensitive buyers, and that matters. That just means that interest costs are going to stay high, and we have to pay more money out of pocket for interest. That's all I'm saying, and I think it's a major structural negative. And I think it's a vicious cycle that's not good. But like you said, there is no alternative.
Right.
And that's why I think it's a moral hazard, because competition is good. In New York City, have you ever been to a bad restaurant? I've never been to a bad restaurant in New York City. I live there. I grew up in New Jersey. Why? Does anyone know why? Competition. If you're a bad restaurant in New York City, you shut down. Right? Let's see going forward how things pan out, but that's the way it always has been. If you're the only guy in the game, and the U.S. is the only game in town for reserve currency and where China can plow their surplus into in treasuries, why would we get our fiscal house in order? No real reason. Why would we? If we have a 6.5% fiscal deficit and we're issuing T-bills which roll over, right? Like they roll over. So you issue a one-year T-bill, every month they're rolling over. You're rolling over at a higher rate, and it's being purchased by guys who care about price. Why would you care?
Yeah, I agree with that. I agree with that point. But I guess what is the optimal outcome? Should we be hoping for like a mini crisis that doesn't hurt Americans too badly, but sort of scares politicians into actually doing something productive about the trajectory? What do you think?
What is the solution?
Yeah.
I think the solution is something that's not going to happen. That's why my base case is that we're going to slow into a very, very low potential growth society. I mean, not dissimilar to Japan. The only difference with us, I think, of course, is that they own their own debt, which is pretty awesome.
Yeah.
We don't. So.
I'm a VAT man. Do you know what that means? I'm a value-added
yeah,
tax man.
I think we've talked about
Yeah.
this.
Yeah, I think
I
think that's the way. That's the way.
Okay, so tell us about value-added tax, and then I want to ask you, do you disagree with me that tariffs have been good for the U.S.?
Yes. What a tariff is trying to do is basically be like a VAT, but it's very inefficient, and it favors certain sectors of the economy unevenly. You can't be a capitalist and love tariffs, but a great alternative that actually would help solve your fiscal deficits is a value-added tax. Now, value-added taxes are often politically unpopular in the beginning. That's why it's a challenge. But I've sometimes toyed with the possibility that Donald Trump is somebody who has been able to do some very unconventional things. So maybe he could sell it to the American people. I got to be honest. I'm not very optimistic about this, but I am still a VAT man.
Yeah, well, I think that's good. It's just interesting to me because tariffs didn't cause the cataclysm that everyone expected them to cause. And in fact, what they've done is they've pushed billions of dollars into the U.S. coffers.
Yeah, so I guess I'll take the other side of that. So when people say that tariffs haven't caused inflation, against what baseline? That's the question, right? So if you go back and you look at the consensus forecast for inflation in, say, September or October, just before the election, it expected that we would be at about 2.2, 2.1% right now. So we're at 3. So you have to use that as the counterfactual. It is true that some people, including in my business, came out with really crazy projections, and that left people with an unrealistic expectation that tariffs were going to be extraordinarily inflationary. I think measured against a reasonable base case, they've been a little less inflationary than people
Do you
thought.
think it's because they've been staggered? They've been somewhat staggered, and the majority have been reciprocal, right? With the intention of bringing the other side lower.
Yeah.
So there's that.
That's definitely been a factor. Some companies are in fact eating the tariffs. I think we focus a lot on large cap companies. That's what we do. We're interested in the S&P 500 here, but I think we have a lot less visibility about what's going on in small businesses across the country. I think that the alternative data that we have suggests that they are struggling a little bit, that this policy has actually hurt American dynamism, and that to the extent that they've swallowed tariffs, we're in a little bit of a no-win situation, because if some dynamism returns next year to the American economy, maybe those businesses that ate the tariffs will just turn around and raise prices then. That's the risk.
Yeah, you're right on that. You're right on that. And maybe we haven't seen yet the impact. It could be delayed. In the first quarter, my understanding is that some of these price pressures could be passed through in the first quarter. But yeah, I do think that that hasn't been as bad as people suggested. Stagflation, recession, high inflation, et cetera. So if we talk, thank you. Yes, is it Q&A time? Okay. So small caps versus large caps. I tend to like either really small or really large, not the middle ones. Just because I think that they can weather this storm more. Do you have an opinion? Or does anyone have an opinion here? I'd be happy to open it up now since it's...
I'm in addition to being a vat man, I'm also a mid-cap man. So,
yeah. I love this.
Yeah.
Oh, so you do take the
We're
other...
having fun here. Yeah.
We're having fun here.
Yeah.
It's so much better when there's divergence of opinion.
Yeah.
It's so boring if two people think the same.
I had a column maybe a year ago where I did sort of an event study on the .com bust and found that mid caps were big outperformers. So I don't know, give them a look. They don't get a lot of attention.
The SMIDs.
Yeah.
I think First Trust has.
Well, I was going to say, actually, Brad and I are going to debate some of this.
Okay, great.
Okay.
We'll leave it to you.
We'll
leave it to you.
thunder.
Let's open it up to any comments, difference of opinion, or questions for either of us, please. Yes, thank you.
So, from what I gather, you seem to think that the Fed is not going to lower the interest rate. And my question is, why do you think that they continue to keep the rates? What is their eye on it? When inflation is here, there's the stock market is going up, but the everyday people are really feeling it hard. So, what's keeping the Fed from not lowering the rates?
Well, financial conditions are actually loose. If you look at the Chicago Financial Conditions Index, they're the lowest since the early 2000s. So the Fed might think that it's in restrictive territory, but you have credit spreads, which is the spread of a corporate credit over US Treasuries at all-time tights. You have record high equity levels. You have credit that's pretty easy to get. Financial conditions are loose, so I think that's one thing. And then I think the fact that we're 5 years, right, apart outside of the 2% target, I think is also another reason. You have seen a softening in the labor market. We have, 6 weeks of no data. But you have seen a softening in the labor market. But I would argue it's not at the point where they need to start slashing rates. I mean, we debate this. I debate it with other economists as well, which is how, like, the NAIRU. And people think it doesn't matter anymore, and that's fine. But I still care, and I think the Fed still cares.
You have to have a view on it, right?
Right. I mean, I think you do.
Yeah.
I've had friends who are PhD economists, I'm not, that say NAIRU doesn't matter anymore.
What's your number?
Well, the Fed's number is 4.9, so I'm going to go with theirs.
Okay.
So 4.9 is the non-accelerating inflation rate of unemployment, above which it would be deflationary, below which it would be inflationary. We're at what, 4.5?
4.3.
4.3, which is historically still low. So I'm not at the point where I think we're on the precipice of recession. I don't agree with the stagflation call. In fact, I think that the neutral rate, which is the long run rate where the Fed could hold at, is higher than what the Fed thinks. So you have guys like Steve Myron, who's a great guy. He thinks the neutral rate is 2%. The Fed majority thinks it's 3%. I think it might be 4%. If the neutral rate's 4%, the Fed doesn't have to cut anymore.
Right.
In fact, they're already too easy.
Yeah.
So I think, to answer your question, then I'd like you, John, to take a stab at it. I think they cut max two times next year. I think they don't hike, and I think they don't cut in December. And I think they only cut if we get a more sustained rollover in the labor market. Like John correctly said, they have a dual mandate. They're failing on the first one, but I would argue that they don't care. I think they're comfortable with the 2.5% core PCE. I think they're comfortable with 3%. I think they're uncomfortable with 3.5%. It's my view. And then unemployment, I think once we start seeing negative non-farm numbers, then they start to cut more aggressively.
Couldn't add anything to that. Yeah, missing on the inflation target. Labor market not obviously a worry if you go by the unemployment rate. It's a two-mandate Fed, and that's it.
Do you think the Fed looks at Nehru like how do they? We're at 4.3% unemployment, which isn't horrific, So yeah, it's moving higher. So what do you think they look at? What do they care about?
Well, so famously, Jerome Powell's first Jackson Hole speech was called something like "Navigating the Stars," and he had this elaborate conceit about how the neutral rates, what we call the stars in economic modeling, the neutral rate for unemployment, the neutral rate for interest rates, they're fundamentally unknowable.
Yeah.
You don't know them. They're
Right.
these marvelous econometric models,
Right.
but they're all basically guesses.
Yeah.
And so what you do is you move slowly when you approach what you think is the neutral rate, and you hope that something in the real world tells you when you're there.
In the layman's world, for example, lowering the interest, and I don't mean slashing it, but the interest rates, to your point, the principal versus the interest payment is really eating up a lot of the household. The purchase of a home is high, yes, but the interest rate is so high that
You can't afford it. Yeah.
So all I'm saying is it's a matter of what numbers do the Fed, and I see the credit easing, et cetera, but in the layman, it's like everybody's waiting for that in order to have a boost of being able to buy a home.
Yeah, you're right. Well, the interesting thing here, ma'am, and what you're talking about, you're so right, is like you look at the Fed has cut 75 bips, 100 bips,
150.
150.
Since
75.
September.
Yeah. Okay.
Since a year ago, right?
So since a year ago,
I don't even know what year.
But the
we're in
30-year
right
mortgage
now.
is still
Yeah.
at the 30-year mortgage is. I know I get 30-year. I travel too much. I'm like, what country am I in? What time is it? How many rate cuts do we have? But anyway, yeah. So I think you're right. I mean, the interesting thing is the Fed cuts rates, but the 30-year mortgage, which is supposed to be attached to the 10-year, hasn't moved.
Right.
You're still locked out. You can sell your house because you made a lot of money on it, but then you can't get a 30-year mortgage out at 8% when you locked in a 30-year mortgage at 2.5%.
Totally.
You're not going to do that.
Right.
And then you can't afford another house. So people are locked out, especially the young generation. They are not homeowners.
Yeah. Exactly. Yeah. I mean, well, let's take another question here.
Unfortunately, we have two bubbles going at the same time. We have the AI bubble and we have the private credit bubble. It's a
Private
bubble.
credit is getting a lot of
I was
airtime.
looking at NVIDIA numbers, and you know that in their third quarter numbers, four customers account for like 60% of the revenue. One of them is CoreWeave. So I saw this circle. It's a spider.
Oh,
It's gonna blow up.
the
It's gonna blow up,
incestuous.
and it's blowing up. I'm sorry, Christine. We agree experienced so many things, but no, stagflation is not coming. We are in stagflation. The housing market is frozen. I have a 3% mortgage. I'm not letting go.
No, of course not. Of course you're not.
And what happened? Because a ton of private equity. Because again, like you are dead. I mean, you are 100% correct. The Fed inflated financial assets, and those who have financial assets benefited. The small guy, no, maybe in their 401k, maybe in their pension, but they didn't have stocks. The stock market is concentrated, and thus private equity too, and all that's good stuff.
That's a good point.
It's frozen. The private equity shops who own a ton of the rentals, they bought at like stupid multiples, and now they can't move it because the small guy, the small person in Miami, if you are a police officer, if you are
you can't afford a house.
buy a home.
It's really a shame. It's really sad.
A shame.
Yeah,
It's shameful.
it is shameful.
And everyone, there's a lot of blame to go, but the thing is, we'll have to digest it.
Yeah.
You know why tariffs didn't cost? You're going to see it right now. One, because first you have the so-called reflation margins. They were pretty high after we came out of the pandemic because of the fiscal stimulus. So they could eat it at first. And also, if you look at the statistics, and I did a little bit of study there, that basically the companies knew what was coming when the Trump administration announced the tariffs, so they gobbled up all the inventory, about 2.58 trillion, if I'm not mistaken, based on official data. So obviously they had all this pre-tariff inventory. As the economy was slowing down, consumption was going down, so they were releasing that, no tariff inventory, and then now that is gone. So now you're seeing the shocks. And now, because of the immigration rates, we don't have cheap labor. So there's no slack in the labor market, which is inflationary.
Yeah.
So that's why we are in stagflation, and with that afoot.
You make a very good point about the private market, because a lot of the more distressed names, that was their the escape valve for financing. Like they couldn't get financing, so they went to the private market. So there's a lot. It's opaque. It's not transparent. They don't mark to market.
Right.
So like Jamie Dimon called it, we see one cockroach, there's a lot of them. So who knows?
Yeah, I mean, the lack of transparency is scary. They call it volatility laundering, the private markets, right?
Volatility laundering?
Yeah, I think that's a Cliff Asness term. The idea being that people think when they add private assets to their portfolio that they're getting uncorrelated returns, but they seem uncorrelated because you're not market to market every day, every quarter, et cetera.
And alternatives are a broad umbrella. There are some less correlated assets, like infrastructure is not correlated, water rights, you can buy that, litigation finance. These are alternative secured assets that are not correlated to the market. But when we're talking about alternatives as an umbrella, we're talking about private equity, private credit, fund of funds, hedge funds, commodities, Bitcoin, all of that stuff. So it's a very, very broad bucket. But I thank you for your point.
I'm going to pause this here. So hopefully you all got a chance to grab some wine and canapes. Are you both sticking around?
I am.
Okay.
I need to leave.
Perfect. Well, if anybody had a question, I promise.
She put me on the
She
spot.
put it for real.
I'm like, I promise we know where Jonathan is to send additional questions this way later. But Kathryn's going to stick around. So with that, we're going to thank you.
Thank you
for
very
your guys'
much.
time.
Thank you so much.